Australian real estate investment trusts are cutting. Let's have a look. Hello everyone, Florian.Heise here, and welcome to another episode of HeiseSays. I have my stein of coffee, and I thought we'd have a look at this article from commercialrealestate.com.au, originally from the Financial Review, regarding Dexus, the largest real estate investment company in Australia that is cutting costs. Now, I've discussed this in other videos. Consumer behaviors are changing, and I'm theorizing that business behaviors will also change, simply because we're all learning to work remotely, take advantage of Zoom, other tools, to work from home, to coordinate, to discuss, avoiding the need for commercial floor area. And I suspect we will see a culture shift in businesses that perhaps weren't brave enough to allow their workers to work from home, and then that may make an impact on the demand for commercial buildings of different grades in our cities. We'll have to see, guys. We'll have to see. So let's have a look. Let's have a look at the two things. First, we'll jump over and we'll look at the Dexus price, and we can see, let's look at the 6-month figures. I mean, it took the hit that everyone else did. In Feb, they were at $13.42. Now they're at $9.04. Its deepest plunge was at $8.21. We'll just jump over here to the data room from the Property Council of Australia. This is a great source of property information. Let's just look at the office sector here to see what we can see. Now, the office stock levels. You can see Sydney much higher than all the rest of us, really. Sydney and Melbourne, CBDs are the lead. Then you have Canberra, then Brisbane, going all the way down to Wollongong. So just keep that in mind. That's a lot of NLA. Now, office vacancies. We can see here the office vacancy rate of January 2020, the beginning of this year, was at 8%. And this is for all Australia. Let's look at Sydney. We can see, what was that? A bit under 5%. Look at this peak we had here. This was after the recession Australia had to have. Look at the vacancy rates there, over 26. But during the GFC, it only climbed up to about 10%. So considering the severity of this recession that we're entering into, and the fact that our technological ability to work from home compared to the 90s is greatly improved, do you think we'll see a repeat of 2008 or a repeat of the early 90s? That's the question I put to you. We'll have to see. And how will this affect these investment trusts? Perhaps they're preparing for it now. So, Australia's largest office landlord, Dexus, has cut the pay of Chief Executive Darren Steinberg and non-executive directors by 15% among temporary measures to prepare for uncertainty in the market and patchy demand for offices in the short term. The pay cut to base salaries and fees, which also includes a 10% cut to all other executive level roles, was implemented for an initial 3-month period from April and will be reviewed at the end of June. The company has also secured additional bank debt facilities totaling $550 million for extra flexibility and to put a freeze on new hires and non-essential spending on consultants, it said in a quarterly update on Tuesday. The pandemic has had a profound impact on the economy and the real estate sector, and we acknowledge that no business, including Dexus, will be immune from the impact of this crisis, he said. Now, here's the thing. Traditionally, you'd think office buildings, commercial buildings, that have a bit of a moat, continue demand even in a recession. But, this is a little different, isn't it? This is pretty tough. The measures would also include redundancies, with the number of roles affected by the pandemic largely as a result of Dexus losing the management rights to New South Wales Treasury Corporation $2.2 billion property portfolio, he said. The shares rose 28 cents or 3.2% to $9.04. Now, while you may think this is negative news, the market is responding positively to it because, well, one would assume they'd priced it in, or they'd priced in greater negative outcomes, or they're just happy that they're responding and preparing. Tuesday's update follows the withdrawal of the group's guidance for distribution growth for the year, which had been upgraded prior to the pandemic taking hold in Australia, with the greater rental growth, higher occupancy, and less capital expenditure that had been anticipated. Instead, the group, which owns and manages a portfolio of office buildings, industry facilities, retail property and healthcare portfolio worth close to $34 billion in total, is now working through requests for rent relief from many of its tenants. So there you go. So the picture certainly has changed. Certainly has changed quite quickly. So their pipeline is intact. New government guidelines introduced through the Commercial Code of Conduct requires landlords to negotiate rent relief in good faith with small and medium enterprise customers with a turnover of less than 50 million that are experiencing financial hardship as a result of the pandemic, where it seems those with a turnover over 50 million are just demanding or refusing to pay rent, as we're seeing so many of the big brands go on rent strike. Dexter said SMEs comprised about 8% of the group's property portfolio by income, and it was working through to establish whether they qualified for rent relief. Office leasing inquiries had fallen, inspection rates had slowed, and lead indicators pointed to a period of uncertainty in the office market across Australia, with demand across the major CBD markets likely to be patchy in the short term, the company said. However, Mr. Steinberg said the group had entered the crisis in a robust position, given its high portfolio occupancy rate of 97.2%, limited new supply in key CBD office markets, and a strong balance sheet with look-through gearing at 25.4%, below the target of 30 to 40%. The eventual recovery will be helped by sizable government fiscal stimulus, a lower for longer interest rate environment, and the ongoing infrastructure pipeline underway in key capital cities, Mr. Steinberg said. Dexus's $11.2 billion pipeline had not been materially affected at this stage, but there had been issues with the heads of agreement not converting to binding leases or tenants seeking to delay lease start dates, he said. Well, Dexus is nevertheless forging ahead with plans in partnership with Fraser Property to build a twin tower development near Sydney Central Station, which is through to the third and final stage of the New South Wales government's unsolicited proposal process. Dexus said a number of opportunities could emerge from the pandemic, including a wider adoption of flexible working arrangements. And wouldn't that have an impact on the demand for commercial property? Mitigating that risk is the fact knowledge jobs are forecast to increase significantly over the next 2 decades, placing a high value on collaboration, which in turn points to the importance of working from an office. You can also collaborate remotely, everyone, in knowledge jobs quite easily. Let me know how many of you have learned that skill. How many of you have started working from home for the first time? Sure, there are a lot of people that can't, but there are a lot of people that can. One of the opportunities Dexus identified was that as the co-working model comes under pressure, there was potential to offer tenants more flexible physical and leasing arrangements. So there you go. Well, think about it. The co-working or shared working model. I wonder how that is going to pan out with some of the big unicorns in that sector. We'll have to see. So there you go, everyone. Dexus are taking steps, responding to the pandemic, concerned that there will be less demand for their product. We'll have to see. I wonder what the vacancy rate for commercial buildings will be in Sydney and Melbourne. If it'll be like the 20% we'll see. And remember, this was years. That over 20% went from 91 to 97. 6 years. 6 years in the last recession we had to have. Sydney, it was over 15% from 92 to 95. So that's a long period of high vacancy. How did Brisbane go? Let's not leave Brisbane out. There you go. We were over 10% from 91 to 97. But now we're already over that. So Brisbane vacancy rates are pretty high. Remember, this varies per category of building. If you have a A grade or A++, it's going to be different demand for that to a C grade or a D grade. I'll do a video going through the different categories of buildings for everyone. But that's for another time. As always, please let me know your thoughts and opinions in the comments below. Are you an investor in Dexus? Are you worried? Or you think it's an opportunity to snap it up now? We'll have to see. Anyway, guys, thanks for watching. Like, share, and subscribe to the channel. If you're a fan, you can support us via our affiliate links at Amazon or eBay, Independent Reserve or Kucoin. You can join the channel on YouTube, Patreon. You can use Gold Pass with the Perth Mint. Support us via our merch from HeiseSays or PayPal. Take care, guys. I'll see you next time.